Good morning, everyone. We will let all of our attendees get into the meeting before we get started. Thank you all for joining. Have a couple announcements this morning and just a few housekeeping items, but we'll get started here momentarily. Just want to give everyone a moment to get in. We had 83 degrees here yesterday, by the way.
Wow. Yeah, I feel like the last time we had a webinar, it was really freezing and a lot of snow. I think we're in the high 60s, which is it's pretty
Yeah.
great. But then the sun goes down and it's immediately, 40. So
Yeah, Colorado gets you like that. We do have just a quick question. Is this a CE webinar?
I believe it is, yeah. Yeah. So you want to make sure you stick around and put in your CFP number at the
Yeah.
end. I think we usually distribute a certificate you can use just for your records for some of the self-report CE, for designations like RICP and so on.
We'll cover that one more time, just as we give everyone just another minute, because people are still coming in and want to make sure our announcements hit as many people as possible.
Zoom has to make bigger doors. Let everybody in around.
-5 in
Okay.
Montana.
Wow.
Yeah, that's pretty freezing. Matt Miller. Hey, Matt Miller.
It was cold this morning here. So I think it was a quick one day of nice weather.
All right. Well, we will go ahead and get started. For those that are still coming in, welcome everyone. This is today's retirement income intel with Justin Fitzpatrick. As we mentioned before, this will have we have applied and will provide CFP CE 1 hour of credit. So at the end, there is a survey where your CFP number will be required. So please submit that to us. Just a part of the requirements as well that you have to attend 50 minutes of the presentation to get credit for that hour. So those are their rules, not ours, and we just want to be clear about that. And then also we do provide some certificates of attendance. So if you have another designation where a certificate of attendance would be beneficial, please let us know. A couple other things we will be out and about in this month of February at the Advise On conference and at the Ed Slot 2-day IRA workshop. So just wanted to let you all know that we will be there. If you will be there, come see us at our booths. Also, we have a new community where advisors can learn about how other advisors are using Income Lab, answer questions among peers. It has been very exciting for us to have, but also our users have provided us with great feedback on how it has been helpful and nice to connect with their peers. So with that, we also have Lab Talk Tuesday coming up next month. So always keeping stuff going for the educational and involvement here at Income Lab. One little item about questions. If you have questions throughout the presentation, please pop them in the Q&A rather than the chat. The chat gets bogged down with people chatting, which is great. But so for the Q&A, please put your questions in there. And if you want to hear that question answered, please like it. And we will address the ones that have the most likes just because sometimes we have a time limit. So with that, I will pass it over to Justin and we will get started.
Thank you, Taylor. Thanks everybody for jumping on this morning. Sounds like people from all over the country, some of them with a 2-hour delay at school. For CE, it is CFP CE, and for any kind of self-report CE, I think IAR CE you need special, that needs to be submitted by us, and I think it even needs to hit some special requirements. So we don't have that. Correct me if I'm wrong, if it is self-report that potentially you could use it, but we did have one question on that in the Q&A. So today's presentation is based in part on an article I wrote for the Kitsis blog. I'm going to just drop it in the chat here in case you're interested in going there and checking things out at some point. So let's get started. This presentation really began with a question that we got persistently for our other monthly webinar, which is Lab Talk Tuesdays, which was essentially around, hey, does anybody know, how far off your capital market assumptions can be without just totally derailing your plan, without making it so that advisors are giving their clients really bad advice? And I thought it was a really great question. I really like this kind of question because it's so practical, and it also it requires data to answer it. So it's the kind of answer that it's an empirical question. It matters, and we can at least hope to have an answer to it. And the reason it matters so much is when you're creating a plan. Yes, we focus at Income Lab, for example, a lot on making sure that the plans you're creating have all of the resources that clients can depend on in retirement, or even in their pre-retirement life, right? Like making sure that the more accurate you get things, the better it'll be. For example, if you put in a pension as adjusted for inflation, that's very different than a pension that's not adjusted for inflation. Things like plan length, the way that you're investing, fees, all of that really has an impact on the quality of the plan and how close it might be to giving people the best advice they can get about the future. But what we haven't talked a lot about is there's a whole other set of assumptions that you're applying to all of your plans, which are assumptions about how the world could work in general, not just for those clients, but just for everybody. And those are capital market assumptions. So that's things like, what do I think the average return of different asset classes will be? What do I think the standard deviation, so the variability of those returns could be? What do I think average inflation will be? What do I think the variability of inflation will be? We've done a whole webinar on inflation, and that particular one I think is not well covered in the industry. Often what we do with software and with analyses is we just assume some flat inflation rate. Well, guess what? Inflation is not steady through time, as we've learned in real life in the last couple of years. So all of those assumptions also go into the mixing pot when you're creating a plan. So like with Income Lab, when you're trying to get to that answer, how much can I spend? You're really saying, how much can I spend given my resources, given some things about me, like plan length and so on, given some goals, like legacy goals and special spending goals, and given my assumptions about how the world can work. And those are capital market assumptions. So to give you a straightforward example, what if you assume, I don't know, a balanced portfolio will give you 6%, net of inflation returns, and you're planning for somebody with a 30-year time horizon, and we look back 30 years from now and we say, oh, it was 4%. Guess we got that wrong. How would that have affected that client? What would that inaccuracy mean to that client in real life? Like how would it affect their life? I think it's important to start by saying it's practically impossible to have correct capital market assumptions. We can't really expect that our capital market assumptions are correct, at least not down to some very precise range, right? Is it 5 or is it 5.1? Is it even 5.5? Like maybe even 5 or 7. There is a huge dispersion in average returns in different asset classes over time, and there's not a lot of evidence that we are particularly good at predicting average returns or standard deviations, probably far less, other types of things like correlations and things like that into the future. So I think it's important to just start with a certain amount of being humble on this. And yes, it's important. We should take time to worry about capital market assumptions, but it would probably be too much to assume that we could ever get them truly right. I found one recent study looking at actual capital market assumptions from 10 years previous, and then asking how did those capital market assumptions do over the next 10 years. So these are 10-year capital market assumptions, which, by the way, is pretty common that you'll see 10-year capital market assumptions from different sources, which also should probably give us pause, since a lot of the plans we're doing are 20, 30, 40 years. And so to the extent that these 10-year capital market assumptions are more near term, it may be helpful to think in those terms. Even if you like the capital market assumptions, do you want to extend them beyond 10 years? Do you want them to go for 30 or 40 years? That's one reason that at Income Lab we have the regime-based Monte Carlo option, where you can do a near term and then the rest of the plan, and you can define how long the near term is. We actually default that to 10 years. But let's look at this a little bit. So what we have along the bottom is different asset classes. And so this author found a bunch of industry capital market assumptions. So it's not just one set. I forget how many it was, might have been 10. And he shows here the ones that are, well, okay, so the average capital market assumptions across all those is the orange dot. And then, interestingly, the range from the highest and lowest is in either gray or green. It's green if the actual average return over that 10 years was within that range. It's gray if it was outside of that range. So you can see here there are only 6 of the 16 that were where the actual return for that asset class was within the range of capital market assumptions that he found across the industry. So 10 out of 16 times it was actually outside of the range. So no one predicted that low or that high of a return. So, and these are not, duffers. These are people who do this for a living, making capital market assumptions, and it's not great. Like the performance is not great. So here's just a summary of that. In the majority of cases, the average capital market assumption was an unreliable guide to future returns, and this is only over the next 10 years. All right. So that's just to say that it is unlikely your capital market assumptions are going to be right. Okay, so let's step back for a second and just ask, like, what are capital market assumptions for in the first place? And actually, there are several things you might be using capital market assumptions for. The most obvious thing you might think they're for is there are predictions about what the actual average return or standard deviation of some asset class will be, right? I mean, isn't that clearly what it's doing? Well, yes, and I can definitely imagine someone wanting to use capital market assumptions for that, to predict the future, to predict what some returns will be. But again, going back to that first question of, let's say someone's starting out on their journey in retirement, you're predicting 6, they get 4 in fact. They wouldn't be so much upset that you were wrong, you said 6, but it was 4. They would be upset if the choices they made turned out to be bad ones, if they had some sort of negative impact on their life. So clients don't necessarily care about, your accuracy in predicting standard deviations. My guess is most of them wouldn't necessarily even know what that is, and nor should they, right? So it's not so much about this sort of ticky-tacky mathematical thing. It's about, how does it affect my life that matters the most. And for that, it's best to think of capital market assumptions as inputs to a process or an algorithm that paints a picture of how the world might work in the future, right? And then we're going to make decisions taking that picture seriously, saying, okay, here's the range of ways the world could work in the future. So we're going to make decisions about how much to spend and so on, based on that picture of the world. So it's not so much did I get the numbers right, it's did I get the picture of the world right. Okay, so how could that affect somebody in their lifetime? Well, we at Income Lab, we like to focus on this core question of retirement. And I'm going to focus on retirement today. Obviously, capital market assumptions matter for pre-retirement. for saving, for things like that. But often it comes down to this question. And we like to joke, we talked to a lot of advisors before building our software, and they said often, if they asked a question like, so how much would you like to spend in retirement? A client would say, well, how much can I have? Right? They're looking for this to answer this question, how much can I have? How much can I spend? And so that's a place we can look for how capital market assumptions affect the advice you give, which is how does it affect the answer to the question, how much can I spend? Are you going to end up, if your capital market assumptions are off, are you going to end up recommending they spend too much in retrospect or too little in retrospect? Okay, so don't let your eyes glaze over at this. You just squint at it. All right, so this is not how most retirement planning or financial planning software actually works. But let's imagine that you had perfect capital market assumptions. And here we just mean your projected mean, your average, and your standard deviation of each asset class. Okay. In this case, I just used a 60-40 stock bond portfolio. If you knew the absolute correct number for each of those in each period in history, right down to the 10th or 100th decimal point, could you have predicted the right amount that someone was able to spend? Right? You might think you could, but unfortunately, the answer is no. You could not. Now, it is very helpful to have had that information. But what I did here, basically, this is a regression that's saying, hey, if my model was these capital market assumptions, averages and standard deviations, compare that to what I actually could have spent over the next, in this case, 30 years. And that's plotted. And then you have a regression line here. And what we see is that 43.5% of the variation in how much someone could have spent historically was explained by mean and standard deviation. Now, 43.5% is actually not bad. That's a pretty high, what's called R squared. But it certainly is not deterministic. Okay, if I know the standard deviation and average return, I can tell you exactly what to spend. Far, far, far from it. This is not going to get you anywhere close to being able to answer that question. So, for example, there are times in history that, in retrospect, the next 30 years, had very different average returns, but the same possible spending level. So what I'm doing here is, like, if any of you are familiar with the Trinity study or with Bill Bengen's work from the 90s, this is what we're talking about here. So these numbers would be different if you had Social Security and all sorts of, maybe the retirement smile, lots of changes there. We're just looking at withdrawing money from a portfolio here. So we can see if you had started retirement in April of 1988, in this case with $1 million, you would have had a 6.4% average real return. So these are net of inflation. And you would have had an 8.4% standard deviation and could have spent about $80,400 a year in sustainable withdrawals. March of 1950 has the same standard deviation, roughly the same sustainable spending, but 2 points less in average return. All right, so you can see you're not going to get a deterministic, if I only knew the returns and standard deviation, I could tell you the spending level. Here we have two cases where everything is the same except the returns. Okay, we're going to be in trouble here. Or you can have the same returns and standard deviation and very different possible spending levels. So again, pretty big differences. Okay, so if having the right capital market assumptions doesn't just get you to a sustainable spending level or to an answer to that question, what can I spend? Because, by the way, this is just looking at portfolio returns. If we started looking at inflation and timing of things, it gets much more complicated. So if we can't do it with just the returns and the withdrawals, it's going to be hopeless for more complex and frankly more realistic plans. So what are capital market assumptions actually doing in a financial plan? It's defining this kind of cloud of possibilities. It's looking at the future and saying, hey, I think this is an accurate picture of the range of things that could happen to you. I don't actually know which of these is going to be your future, but I think it's found within this cloud. So that's what capital market assumptions do. They are not saying, for example, if I assume a 5% average return, I'm not actually saying I think you'll get 5% returns. I mean, in a sense, you're saying that because you think that's the best average, but you will not at all be surprised if it's not 5. That might be a better way to put it. Okay. So the first question we can ask is, do capital market assumptions actually paint an accurate picture of the world? So do they get this cloud of possibilities right? This is just, by the way, to back up that point about the 5% average. I just took really quickly. I did a 30-year Monte Carlo, just annual returns, average 5, 10% standard deviation, and 1,000 runs. And yes, the most common thing to find in that cloud of possibilities was that, you can see here, kind of 4 to 6% range. But I found one with a 12% average return and one with a negative 0.7% return. Right now, those are way out on the tails, right? But you can see that's what kind of averaging, or that's what sort of simulating things with randomization in the case of Monte Carlo does. It's also, if I did this historically, you'd see a similar graph, right? You see periods with all sorts of different average returns. Okay, so let's ask the question. So what we're doing here so far is we've said, all right, what if I knew the correct capital market assumptions, meaning I actually knew what my average and standard deviation would be in the future. If I knew that, what would I predict is the risk of different spending levels? And here what we have is, this is from Income Lab, so you're probably familiar with this picture. This is our historical analysis graph, which is saying at each point in time, if you had retired with the particular plan you're looking at, and this was a fairly complicated plan with Social Security and pensions and all sorts of things in it, how much could you have spent and still hit all your goals, hit your spending goals, your legacy goal, and so on? And the only point to see here is that there's a wide variation, right? We got low periods, high periods, peaks and valleys, and so on. So the question is, if at each point in history I had known the capital market assumptions, the correct ones, and you had asked me for any of these spending levels, well, how risky do you think this is, right? So in 1982, where that's that peak over on the right, it's over $40,000 a month in spending for this particular plan. If I had said to you, okay, I want you to use these capital market assumptions, and I want you to tell me whether spending $40,000 a month is going to be risky, and how risky it is, right? Or in the 1960s, if I had said, here's my capital market assumptions, and I want you to tell me how risky a $24,000 a month spending would be, right? Not knowing that actually that is going to be possible, right? But just saying, hey, would this be risky or not? There's a huge range. So essentially, if I look back through history and I asked that question, sometimes I would have said, this is incredibly risky. This has, and we define risk as risk of overspending. So risk that you are spending beyond your means, right? So there were a ton of cases. In fact, the most common thing to find, over 16% of history, I would have predicted that spending level had a 70 to 80% chance of overspending, right? In other words, I wouldn't have recommended that you spend the actual sustainable spending level. It would have appeared far too risky to begin with. However, there are also places where the actual spending level would have seemed, frankly, like a little low, right? 0 to 10% chance of overspending. I would have probably looked at that and said, okay, yeah, I mean, you can do that. It's just being very conservative. This is probably going to be way too low and you'll end up spending more through your lifetime. So what you see here is if I look back at history, knowing the correct capital market assumptions, and then asked myself what the risk of the spending level was, I would have gotten answers all over the board. What's interesting though is I would not have gotten answers outside of this cloud of possibilities. So I wouldn't have found cases where the actual spending level I could have taken, which I wouldn't have known at the time, right? But if I had perfect foresight, the actual spending level would have been outside of that cloud of possibilities. So capital market assumptions are they are providing a good picture of the possible world I could live through. Just to give you a specific example, because that can be a little bit complex. Let's say I'm sitting in November of 1980, and I am given through a magical crystal ball that the correct average returns for this portfolio will be 7.3%. Standard deviation will be 9.7%. And then I ask myself, should I be able to spend $90,000 a month? Or sorry, this is annual, so $90,000 a year. I would have said, well, no, that would be overspending. I would have said that's an 80% chance of overspending. So probably I would not have given that advice. Now it turns out I could have spent that, right? But a priori, ahead of time, I would have said that, so that's too risky. In May of 1969, if I had, again, my magic crystal ball comes back, I've got 6.5% return, 10.2% standard deviation, and I ask myself, can I spend $43,000 a year? I would have said, yeah, that's really low risk. I mean, frankly, I'd spend a little more, 5% risk of overspending. You're being a little conservative here. But in fact, that was the correct amount. All right, so you can see this kind of range of actual spending versus risk. Okay, so another way to think about it is if we had these perfect foresight capital market assumptions, we actually can set pretty good bookends or limits on possible spending levels. So we're realistically defining kind of low and high limits with good capital market assumptions. We also actually get a decent look at risk with capital market assumptions. So even though I can find those outliers, like the case where ahead of time I would have said that's way too risky, I'm basically getting a distribution within that picture of the future it's spread out, and as I have here, 89% of historical spending levels fell within the middle 80%. 68% were in the middle 60%, right? So it's not a bad distribution. It's painting a decent picture of the way the world can work. But of course, that's not good enough, right? Your clients don't come to you and say, "Hey, paint me an abstract picture of the way the world could work in the future." No, they want to actually know what to spend today, right? You have to give them advice. You have to take a stand, have an opinion on something. And given that we know capital market assumptions are unlikely to be right, how far off can they be, and you still get decent advice? Okay, so in order to answer that question, we have to get into, well, what do we mean? Like, what's the process of giving someone advice on what they can spend in retirement? And here I'm going to depend on another article that I wrote last year for kitsis.com about this concept of overspending and underspending. And what we're after with giving spending advice in retirement is someone's really asking they want to live within their means, right? And it's something that's easy to do when you're in your working years, if you're receiving a paycheck, because just spend less than you make. That's living within your means. In retirement, if you're not living entirely on wages anymore, you still want to live within your means. You just don't know what your means are. And so how much can I spend is really all about, hey, find me a spending level that is spending within my means, not spending beyond my means. And the way we think about this is there's two risks. There's a risk of overspending and there's a risk of underspending. The risk of overspending is kind of obvious, right? We don't want to overtax our resources, find ourselves in a bad position later on. The risk of underspending, I think, is underappreciated, and there's a segment of retirees, and they tend to be overrepresented, I think, among clients of financial advisors, of people who are at some pretty high underspending risk, which is essentially the risk of regret, the risk of looking back on your life and thinking, wow, I worked too long. I have all this money. I'm never going to spend it. Or, wow, I skipped that vacation or those experiences with my kids or friends or grandkids, and I could have done them. And now I've slowed down too much. I can't do them. So that's underspending risk. So we want a balance of these risks. Both always exist, but we want to balance those risks. And an advisor will typically find a target balance in order to give their advice. So for example, here, I have them targeting a 25% chance of overspending, a 75% chance of underspending. Typically, you'll be targeting within the underspending zone, not in the overspending zone. In the overspending zone, you're saying, no, my assumptions say this is likely to be overspending. I'm not going to give you advice to overspend, right? But somewhere to the left of this. Okay, and we need to know this in order to answer the question, how far off can my capital market assumptions be? Because the point is, you're going to give them advice on how much to spend. What you don't want is to look back and say, oh, my capital market assumptions were so far off that if I fix them and made them correct, I actually would have been recommending overspending. Like we want to avoid recommending overspending. There's a flip side to that, which is we don't want to recommend underspending either. Of course, that's a really big deal, but clearly the one most people care about is the overspending. So how much can capital market assumptions be overestimated without accidentally advising clients to overspend? That's the question we have. So, back to that example we started with, if in fact someone's going to experience 4% average returns, how bad would it be to instead assume 6, right? How badly can I overestimate without accidentally advising clients to overspend? And what we need to know here is what your target risk of overspending is. So from the article, I had said, let's take a more conservative plan. I think this is the most common target that we've seen kind of in a public survey. So Derek Tharp, I remember, just did a LinkedIn poll asking, hey, no, he was using the terminology of probability of success, which we don't use for many reasons. You can go back to lots and lots of webinars on that. But people were often targeting a 90% probability of success. So translating that into more accurate overspending, underspending, that's a 10% risk of overspending. So looking back historically, if an advisor had targeted a 10% risk of overspending, 90% risk of underspending, they could have overestimated their average return. This is still a 60-40 portfolio, so numbers would be different for different portfolios. They could have overestimated their average return by the numbers on the left-hand column and still not recommended overspending by the numbers in the right-hand column. So to give you an example, they could have overestimated the average return by 3%, and 58% of the time, they still would have been giving what we could consider good advice because they would not have been advising overspending. Being off by 2%, 70% of the time, you're still safe. Being off by 1%, 82% of the time, you're still in good shape, right? Now, the further off you are, the less often you're still in the clear, right? You can be off by 6%, but only 14% of the time, right? And most of us would not be very happy picking when we're in that 14% of the time, right? So another way to look at this is that 14% of the time, those are those periods where you would have looked at that spending level and said, whoa, that is way too risky, right? If you had used the accurate capital market assumptions. So those are those cases like where we saw a case with $90,000 in spending from a $1 million portfolio. But you can see here, you can be off by a couple percent easily, and still the vast majority of the time be, safe. Another way to look at this is I like to think of this as your margin for error. Like how far off can you be from the actual in this case, average return. So for this study, in this case, I used long-term historical standard deviation. I just kept it constant, right? Because most people don't have feelings about standard deviation. I've almost never talked to an advisor who'd come and said, yeah, I'm totally, I'm not sure about average, but I've got standard deviation down. No. So I just held standard deviation constant and then said, okay, how far off could I be on the average return assumption? And you can see there's a big range. And you can see, again, the most common was actually 4 to 5% of the time. It was, over 17, or sorry, 4 to 5% off, so 4 to 5% too high, and yet 17% of the time you still would have been in good shape. So lots of stuff up on this upper end, but very worryingly, there is also, over 5% of the time, there's no margin for error in this situation. If you think about that, that makes some sense because we're targeting a 10% risk of overspending. So we're actually saying, yeah, there can be some situations where I'll be overshooting. That's what you're saying, because you're not pegging it to, I want to be 100% sure I'll never be overspending. So that's equivalent to saying there's no margin for error in those situations, because in fact, you should be predicting less. So this, on the one hand, I think gives people some comfort knowing that like there are lots of situations where you can be off by a fair amount and you're still in good shape. But I wouldn't take that too far because there are plenty of situations where 1% or less might be too much. And as we've seen, I mean, being off by 1% is easy. I mean, you almost would want to assume you're off by at least 1%. Right? Okay, which means yes, I think we can take some comfort from this, but I think it also shows that there just is no way we can depend on capital market assumptions to lead us to giving, perfect advice. There will still be situations where you have overestimated or underestimated by enough that you'll need course corrections mid-plan. So far we've been talking about plans that are static in the sense of you just tell somebody how much to spend and they go do it. And then sometime in the next 30 years, we see whether it was too much or too little. That's not realistic. That's not how people actually live their lives. We've done lots of webinars on that as well. People adjust. People take in new information. Certainly people adjust just because lives change, but also people will adjust based on the circumstances around them. So if somebody gets a raise, they spend more. If they lose their job, they spend less. They cancel that vacation. That's just the way things work. So the right way to live in a world where capital market assumptions will most likely be wrong, but that they often can be off by a fair amount without major influence on a client's plan, is this kind of 5-step approach, which is, again, we begin with a full picture of the client's resources, needs, preferences, goals, and so on. We combine that with a reasonable model of the world, including capital market assumptions. And they should be as good as we can make them. I'm not saying that capital market assumptions don't matter, so we should just flip a coin or whatever. We probably could talk, and maybe we will in the question period, about how you produce capital market assumptions in the first place. But we do want to, do the best we can with them. And that will help us define that cloud of possible futures, right? That way things could go in the future. Then from within that set of ways the world could go, we want to find a spending level that aligns the clients with the client's risk preferences. So you want to balance their ability and willingness to take on risk. In this case, risk is cuts in spending. Future cuts in spending. So unplanned, unhoped for cuts in spending. We want to balance that ability and willingness to take risk with the desire to spend their money and live life well. Like I said, we also want to avoid the risk of regret, which we've heard lots of stories about that. If you go back to our master class with Jason Jewell last year, and with Ryan Townsley, we all talked about this quite a bit. So we want to balance those two things. And that becomes the answer to the question, how much can I spend? If you're particularly concerned that your return assumptions could be too high, you can target a spending level with a lower risk of overspending. So this is another thing I want to make sure we talk about is there are many, many places we can make plans conservative, where we can pull back risk. And so we need to be careful not to do that in many places of the plan, not realizing that we've actually kind of compounded those adjustments. So for example, you could reduce your capital market assumptions to be more conservative. But if you also then reduce the risk in the plan, that's a double, so that compounds on itself. So I could, assume 3% returns, and I want to target a 95% chance of underspending, but those work together, right? So I would encourage people to be cognizant of where you've kind of put your hands on the balance, and made things a little more conservative. So kind of choose the place to do that. I haven't thought super deeply about this, but I think the way to do that is to just target a lower risk of your spending level rather than adjusting the capital market assumptions. I think you're best off setting capital market assumptions to what you actually think are the best projections. Okay, step 4 then, and this is the key, because step 3 will give you a spending level, and you should feel, confident in giving us advice. But we also, since we're going to be humble about this, we set guardrails, which signal when the clients can spend more because their risk of underspending is now too high, or less because their risk of overspending is too high. So this is basically saying these capital market assumptions, A, they could be wrong. B, even if they are right, they're not necessarily going to get me to the exact right spending level. And so over time, as we learn what world we're living through, as we learn, oh, has inflation been particularly high or was it particularly low? Were returns particularly high or particularly low? Then we'll realize, oh, we're trending toward one guardrail or the other. And at some point we hit them and we'll actually adjust. To fail to adjust would be like saying, over time, I learn nothing. Over time, I get no additional information. But of course, that's wrong. If we're working with clients over time, we're getting new information all the time, and it makes sense to update plans and eventually make adjustments. And so a big part of this, which, if you have your CFP, this is the last step in the financial planning process, is updating and monitoring the plan regularly. So having a plan to do that is part of financial planning. And so in this case, adjusting spending or adjusting parts of the plan in order to keep risk in a reasonable range is a key part of just living in a world where our capital market assumptions will likely not be right. And even if they were right, we would not necessarily be giving the quote unquote right advice ahead of time on how much to spend. So an example of this, we have gone over the retirement stress test a bunch of times, and I won't go over it today, but essentially you can see how by having guardrails, by looking back through history, you can see how plans would adjust and keep on track. Because essentially in this retirement stress test, which hopefully you've seen, if you haven't, definitely check it out, you're seeing exactly what we've been talking about today, which is these plans, when we're simulating someone walking through history, making adjustments, they begin with capital market assumptions. And those capital market assumptions do not have any foresight. And so this is really showing you what living through a world where you don't know what's about to happen, how that works. And the amazing thing is by having guardrails, you stay on track pretty well and often can achieve some pretty good experiences for clients. And like I said, when we ask the question, what happens when my capital market assumptions are wrong? It's not that, at the end of somebody's plan, they look back and they give you a grade like, oh, your capital market assumption was 6, but it was really 4. I'm going to put the red pen on that one. Nobody cares about that. What they want to know is, did you give me good advice? Was I able to live the life that I wanted to, given the world that I happened to live through? And all clients know that we don't control that, right? That's just, we're going to live through something. Let's see if we can navigate it as well as possible. And that's the key to to getting the plans as right as we can get them, living in a world where we just have imperfect assumptions and less than perfect, foresight. So with that, I know we have a bunch of questions, and someone said, "Can we get these slides?" Yes, we'll create a PDF of them and send those out. So make sure. I guess we already have your email addresses probably. Let's see. Lots of upvotes on a couple of them. So I guess I'll just take the ones with the most upvotes.
One message with the slides, there will also be a recording that we're sending out as well as a follow-up to this email or to this session. It'll be in the next day. Go ahead, Justin.
In that Kids' article, it didn't go quite as in depth as I went today on some of these things, but it's a pretty good summary of some of these topics. Okay, so can you give a brief overview of how Income Lab performs its calculation to determine the spending capacity and how much impact the CMAs have on that number? Okay, so I mean, what I outlined there is essentially how we do it. So first we say, given your assumptions, which could be your capital market assumptions, or we also have, you can use historical analysis, which is we're not randomizing then we're saying, what are the actual sequences of returns and inflation? I know I mentioned that earlier, but as far as I know, we're the only, strangely, the only software that actually assumes that inflation can vary, which is a really big deal. We say, okay, so given that, how could the world work, right? What's the cloud of possibilities? However you want to think about it. What are the bookends on lowest and highest spending? Because in each way the world could work, there is an amount you could spend if you happen to know that ahead of time. Now you don't know that ahead of time, right? But you still have a model of the world. So that's what we do. That's how we determine that. And then we have a slider, we have custom settings, all sorts of things where you would then target particular risk levels. We talk about it as risk of overspending and risk of underspending. And typically people, like I said, they want, less than a 50% chance of overspending, often well less. They'll start with kind of a risk buffer, right? They'll say, hey, I know I'm probably underspending, but like let's shoot for kind of, 80-20 or 70-30 or something like that. Okay, where do Income Labs default traditional Monte Carlo capital market assumptions come from? Okay, so we use our goal with our default capital market assumptions is that Income Lab not have a point of view on these things. So there are firms that create capital market assumptions that are expressing a point of view. They're saying, hey, we think given, where things are, we're putting our finger on the scale. We don't do that. So instead, we just use asset class returns from representative indices. And we, in the case of our traditional capital market assumptions, they're 50-year averages. There are a couple of exceptions where we don't have enough data for that, and one where it's just because people wanted a different, we do inflation, we do 30 years. If you do 50, you end up with a really high inflation assumption, and people for traditional Monte Carlo kind of wanted it to come around in sort of the 2.5% to 3% range. So that's where they come from. They're just averages. They are the way that we state them, and we do plan on adding a feature this year, but we state them in net of inflation amounts. Many people think more in gross of inflation, nominal amounts, and so we're going to give you the option to do either one this year, but just that's an important thing to look at. Also, by the way, this is a little bit nerdy, but we are actually giving you average real returns. We're not doing average nominal minus average inflation. And that matters because each month there's a different amount of inflation. So sometimes people will look at those and say, well, these look a little high. Partly, I think that's because often we don't appreciate how high average returns actually have been. I haven't looked lately, but I think average large cap US returns over the last 50 years or something, it's like 13%. It's really high. And I get it that you probably don't want to assume that, but that just is the fact of the matter. And so often we will have people look at it and say, wow, that's a high number. And it's like, yeah, it is. And if you want to change it, that's perfectly fine. All right.
You see the part 2 of that question? Of the...
Oh, yeah, that's true. So we do update our defaults every month. Now, for those things, adding 1 month and dropping, the month from 50 years ago is not going to make huge differences in the actual capital market assumptions, but over time it will change. We do defaults for regime-based Monte Carlo as well. And there is the way we get those is we want defaults for the next 10 years and defaults for everything after that. We have a whole article on how we do that, but it's essentially using that economic, here, in fact, I can show you, go back to this graph here. So in this graph, you'll notice there are some blue periods and some gray periods. And the blue periods are periods that are most like today in economic terms. So we're talking about inflation, PEs, CAPE, things like that. The gray periods are least like today. And we're not kind of calling tops and bottoms of the market. What we're saying here is, I don't know whether we're at the top of the market today, but I know we're not at the bottom, right? So let's get rid of periods that are at the bottom. It's that kind of thing, right? That's what this filtering is doing. So in order to create our defaults for regime-based Monte Carlo, we're using the blue periods instead of the gray. That's one way to think about it. So over time, if you have a plan, and you just hit refresh every month, you'll see the numbers change slightly, and that's because the default capital market assumptions have changed. If you've set your own custom assumptions, that won't be true. It may change, but only because that person's a month older, Social Security is a month closer, right? Things like that. But it won't be because of your assumptions having changed. And if you think about it over time, as we talked about, retirement planning, financial planning in general, is not about just giving you, the map and handing it over. It's about being a guide along the way. It's about making adjustments. Part of that is making changes to how you assume the world might look in the future. And so updating capital market assumptions is one way to do that. All right. Let's see, we've got a few more with some upvotes. Okay, it is a really good question. Brian asks, if a client has a good idea of how much they will spend, can you reverse engineer the process to find out how risky that might be? Yes, absolutely. Yeah, it's just exactly the way you put it, is you have a picture of the world, it's this cloud of possibilities, and you say, okay, is your spending level you want in that cloud? If so, is it high in the cloud or low in the cloud? Is it outside of the range? We actually often see situations where what someone is spending and probably wants to spend is outside of the cloud on the low end. So that's a pretty common thing I hear from advisors is, just getting someone to kind of live a little enough to at least be within the range of things that they think might happen. Now, if they're outside on the high end, there's probably some work to be done. That's a tough situation. Let's see here. Okay, what about the idea of adjusting CMAs up or down based on current stock CAPE level? Essentially, that is what we're doing with that, with either the regime-based Monte Carlo assumptions, or actually in historical, you can do it as well. There's a slider at the bottom of that same mountain graph I was showing with the blue and gray. You can say, hey, should I just look at the blue areas? Do I want a little more blue? Do I want the whole thing to be blue? That's essentially what you're doing. Now, we're not just doing CAPE, but there's a handful of factors that we're using there, which you can find in our help center. Off the top of my head, there's a few others. I know inflation's one. I think interest rates. I think average investor stock allocation is one, if I remember right. I'm not sure I have them all. So yeah, I mean, that actually has a big effect where, if CAPE is way down, you're probably not assuming anymore that, things are about to get terrible. They've already gotten terrible. So that's a little bit of a way to include a little bit of reversion to the mean in your planning. Okay. So I don't know, Robert's question, I'm assuming this was related to a particular slide, and I don't know which slide that was. So if you want to add which slide it was, I can address that, but I'm not sure what it was.
It was kind of towards the beginning.
To the beginning. Sustainable spending, same returns, different returns. Oh, right. It was these examples. Okay. Yeah, that's a great question. Okay, I'm going to pull this one up. All right, so this is a head scratcher, is essentially what Robert's saying. Yeah, it's a serious head scratcher. Now, these are assuming that in all of these cases, you had $1 million, right? And the answer is like, let's take the first one, different returns, same spending. How could you have different average returns, but the same spending level? The answer is sequence of returns. So this is a great example of why it's not the average return that is determinative of how much you can spend. If it were, life would be so much easier. But because you're taking money out, it's the sequence of returns that matters. And so I'd have to look at these examples to see exactly what we saw, but it's because of the actual sequence. Yes, the sequences averaged out to 6.4 and 4.4, but one had better sequence of returns, one had worse sequence of returns. And then the same thing for down below, same returns, different spending. That's because, yeah, when you average them out, it's all 4.2, and even the standard deviation is roughly the same, but the actual sequence was different. So, the 1954, you had better sequence of returns because you got to spend more. So, yeah, I mean, this is a great example of why it's not averages, it's sequences that matter. Now, the two are related, right? You're not going to get just absolute dissociation between the averages and the actual returns you get month by month or year by year, but it really matters. By the way, the sequence of returns matters in pre-retirement as well. I know we like to sort of pretend that everyone just magically arrives at retirement with a certain amount of money, and in this case, I did exactly that. I said they have $1 million. Well, the returns they get before retirement matter too. Is you're saving money into it, right? So sequence of returns is just a constant companion in financial planning. There's just no way to avoid it. All right.
We have time maybe just for one more because that survey will pop up as soon as we end the webinar here. So just a friendly reminder for those who are wanting to see CFPCE, just hang tight. It'll pop up when we do in the webinar.
Okay. Yeah, I'll take this one then. Somebody was asking about a prior research on regime-based and traditional Monte Carlo. That is true. And Derek Tharp and I did a study basically saying how good of forecasts do these provide? And there we were talking about forecasting spending levels as well. So it really was about, being as, in the real world as possible. And you're right. At least the way that we were doing it, which was using historical averages over a window for traditional, and then the same thing for regime-based. And we also looked at historical, and we found historical to be sort of the most accurate over long periods of time, but it could be over or under predicting quite a bit, whereas regime-based tended to be decently accurate and was often, I think we called it had a wet bias. It told people to bring an umbrella even on days when it was going to be sunny, basically. So it was kind of under promising, over delivering more often. So yeah, our conclusions there were, wow, historical and regime based definitely look better than traditional with those caveats. So with that, thank you everybody. I know we didn't get to absolutely every question, but hopefully we handled most of them. And yeah, please answer the survey at the end, and have a great week.
Thank you, Justin. Thank you all for attending.
Bye.